Many people balk at investing a large amount of money in the stock market. For them, the amount could represent a significant portion of their assets, and they're worried that the market may drop right after they decide to invest. This is normal. Markets fluctuate, and since no one can predict what will happen in the next 6 months, this is indeed a distinct possibility. Some even decide to wait for a market correction or downturn before doing anything. It's a brilliant strategy, at least in theory. The problem is that the market goes up more often than it goes down, 3 years out of 4 to be exact. And besides, the probability of making money in the stock market increases the longer you stay invested, not on the sidelines. I'm Maxime Dubé, Portfolio Manager at Claret, and in this video I'll be explaining why you should invest now, and I'll also describe 2 strategies to choose from to help you make the right decision. Several studies have shown that attempting to enter and exit the market with perfect timing is an impossible thing to do consistently. Peter Lynch, one of the most successful investors of all time, also said, "Far more money has been lost by investors preparing for corrections than has been lost in corrections themselves." The reason for that is simple. You couldn't be in for a long wait. As I said, the stock market goes up much more often than it goes down. If you're convinced that staying in cash is probably not the best bet in the long run, here are 2 options. First, you invest the entire amount at once, what we call a lump sum contribution, or you divide the amount by a set number of months or weeks, if you prefer, and commit to investing that amount every month or week, no matter what happens in the market. This is what's called dollar cost averaging. Let's look at the first option, a lump sum contribution. Based on historical performance, studies suggest that investing the full amount all at once would be the best thing to do. For instance, since 1929, had you been able to invest in the S&P 500 at any time at the beginning of the month, you would have been better off making a lump sum contribution 7 times out of 10, rather than investing equal amounts of money over 12 months. On a similar note, Vanguard published a study suggesting that the longer the period over which you invest the amount, the less likely it is that your return will be higher. The market can go up or down in a short period of time. If you are unfortunate enough to invest just before it goes down, chances are you will regret it. It can also be stressful, especially if it's your first time investing or if a large amount of money relative to your assets is involved. Now let's look at the second option, dollar cost averaging. This option reduces the risk of losing money from the start since you only put in a portion of the money you intend to invest each month. It allows you to take advantage of natural market fluctuations. Each time the market drops, you'll find yourself buying more than what you bought before. Should the market rise while you're making your regular investments, you'll probably leave a little money on the table, but at least you'll have participated in some of the market's rise. There's also a good chance you'll have spent less time worrying about it. I believe that being a good investor is more about knowing how to place the odds in your favor than having the ability to predict the future. It's also important to understand our individual relationship towards money and to set up solutions that prevent us from making costly mistakes. Both strategies explained in this video are appropriate and should be considered while taking your personality into account. If you have money to invest, choosing between investing the full amount now, over 3 months, 6 months, or even a year, is something you should think about. Remember, the longer the period you choose, the more money you are potentially leaving on the table, but perhaps the more comfortable you'll feel. Thanks for watching. I'm Maxime Dubé, Portfolio Manager at Claret, and if you enjoyed this video, please feel free to share it with a friend, a colleague, or a family member who might like it too. For more investment tips, visit our website at claret.ca and don't forget to click on the subscribe button below.